Welcome to Capitalize Your Finances, the podcast that's your ultimate guide to mastering personal finances and unlocking the secrets of entrepreneurship. Each week, we dive into the world of personal finance and business development and have fascinating conversations with industry experts, seasoned entrepreneurs, and thought leaders who share their insights, strategies, and stories to help you get ahead in life. Whether you're a seasoned entrepreneur looking to scale your business or someone just starting out on your financial path, this podcast is your go-to resource for inspiration and actionable insights.
Welcome back to Capitalize Your Finances. As always, I'm your host, Christopher Panayiotou, certified financial planning professional, the Cap and Capitalize. And on today's episode, I'm going to go over what not to do when selecting a financial advisor. But before we get into it, the free advice for the week. When it comes to personal finance, when in doubt, expand your time horizon. When it comes to personal development, shorten your time horizon. You combine these two and your success will skyrocket. And now that we've got this free piece of advice out of the way, let's get into today's episode on what not to do when selecting a financial advisor. And let me be really, really clear. I get it. Like, I really get it when it comes to the topic of hiring a financial advisor. Hiring an advisor, it's a big deal. And think about it. You're trusting someone to oversee your entire financial well-being. There was an interesting study published a couple of years ago that's resurfaced by Northwestern Mutual, and it came out in 2022, and it's called Planning in Progress. And this study dove into the attitudes and behavior regarding Americans and their money. And the study found that 71% of Americans felt their financial planning needed improvement, when only 29% of Americans worked with a financial advisor. And we'll get into financial advisor versus planners in a bit. And the study covered a bunch of topics in regarding to what someone should do. However, I want to dive into what I found infinitely more valuable, the 6 major no-nos. And what I'm going to do is go over each one. And as I'm progressing through this list, I will give you my take on the validity on these no-nos. So the first one, don't hire a non-fiduciary financial advisor. A fiduciary financial advisor is held to a strict fiduciary standard. And that commitment is extremely powerful. It means that they, meaning the planner advisor, must always act in the best interest of their client, avoid or disclose any potential conflicts of interest, and provide any relevant facts to their clients. I'm reading this directly from the study. And hiring an advisor who is not a fiduciary means that they could recommend decisions that may not be in your best interest. And I'm sure you've seen that in commercials throughout the years, especially since they made this push in 2016, 17. All that sounds great. Here's my take. This is true. However, the whole fiduciary, quote unquote, term, it's a bit overused, and you need to know the technical reasons behind why fiduciary and fee only has become the popular standard in our industry. So it's going to get a little bit technical, and I may vent a little bit, so just hear me out. So there's 2 major regulatory bodies in our industry. There's the Securities Exchange Commission, the SEC, not the Southeastern Conference, and then there's FINRA, the Financial Industry Regulatory Authority. And about a decade ago, there was a lot of how should we say this? Headbutting between the two of them. And the SEC got really, really close with the CFP board, the Certified Financial Planning Board, and they've really done a great job of drilling into your heads as the consumer, that in order to be a CFP, a Certified Financial Planner, which is what I am, you have to be a fiduciary and put the client's interest at the forefront. Okay, that's again still all true. And And then if that's the case, because if you're only regulated through the SEC, it's fee only. Well, FINRA, you're able to charge commission-based products for better or worse. It's really not for better or worse. It just is what it is. But the SEC and the CFP have pushed so freaking hard. And let's face it, how easy is it to market yourself as an advisor and say, well, we're a fiduciary, we're fee only, we put your interest before ours at all times? It's pretty easy. Well, this is what happens behind the scenes in our industry. The semantics of being a fiduciary or fee only, all these planners are doing is they're masking themselves as such, but they're really just providing 1 to 2 portfolios across all of their clients, because not only is it the right thing to do, they get reoccurring revenue. On top of that, it's more profitable because someday when they decide to go and sell their business, they are going to get a higher multiple because it's not like they have to customize every single client. Sorry. Like, I can tell you right now, I have built my business to not be that great when it comes to the sales side of things, because I don't want to sell my business ever. I want to provide true, prudent planning. And unfortunately, that is a dying art, and I'm doing everything I can to bring it back. So that's my take. Yes, you want to hire someone that is truly putting your interest before theirs. However, dig into it a little bit more when you're talking to people. And if it just sounds like a CFP commercial, you probably need to look elsewhere. The second big no-no: don't simply hire the first financial advisor you find. Try to resist the temptation to quickly cross the hire a financial advisor to do off your to-do list. It may be convenient to select the first one you meet, and for whatever reason, it's close to your home, it's within your family, maybe it's close to your family. A decision as big as your financial future, it's going to require more cursory consideration. And you can find vetted financial advisors to interview before committing. Like, it's really not that hard. And before you commit to the advisor, it is important for you to do your research, and it is important to compare. Again, this is all from that study. But of course, I got to give you my take. I agree. However, you're probably catching the theme with this episode. If someone you deeply admire and respect immediately gives you someone's name, like without hesitation, and they're the ones using this person, there's value in that, like in and of itself. I'm not saying vetting multiple people is not important, but I wouldn't go overboard. Also, I'm going to tell you from a planner's perspective, if I knew that I'm advisor 8 or 9 on the list, I'm going to do whatever I can sitting across from that person or couple to let them know that they can find someone else, because that tells me whoever it is that I'm talking to, they don't know what they want. 8 or 9 is ridiculous. I know with the CFP board, it is best practices to give 3 names for a CPA, for an insurance specialist, for an attorney. I mean, like, the list goes on and on and on. Well, a lot of these regulators they don't have, like, they're not real people. They don't actively go through life going, okay, so this person is going to spend hours and days and months going through all these interviews and being bombarded with meetings and having to compare and contrast everything. And then they're not going to actually do anything because it's, it's decision paralysis. So, again, maybe compare 1 or 2, maybe 3. Again, because I'm required to say that by my CFP board, but also, like, be a real person and use some common sense. The number 3 not to do: don't partner with an advisor whose strategy doesn't align with yours. This is an interesting one. Your overall potential risk tolerance can be a personal preference, one that could vary widely among financial advisors. Some advisors could have a penchant for aggressive stock investments, while others may encourage more secure bonds, as an example. You may want to consider looking for an advisor whose risk tolerance either matches or is willing to match yours. Here's my take. In regards to alignment, I agree. And I think that one's pretty obvious. Like, you should work with someone, regardless of advising, just in life, that aligns with what you're trying to do. That's pretty common sense. The details of the study miss the mark. So if an advisor has the direct quote, a penchant for aggressive stock investments or encourages more secure bonds, that is not comprehensive financial planning at all. And here's the brutal truth bomb for all of you listening in. Most financial planners, let alone advisors, don't actually plan. I said it. Most planners don't plan. Most planners, there's no planning principles at all. And I've seen this so many times in my career. I took over a client late last year, obviously, removing names, and it was one of the big wirehouse firms, which I'll also remain nameless. And this was seemingly one of the best planners in Bellevue, Washington. And I'm in Tacoma down south. And I looked at this account, and this client had a trust account, an IRA, a Roth IRA, an inherited IRA, and an inherited Roth IRA. Okay. So a lot of balls up in the air. Every single account was invested the exact same way. So here is supposedly this planner at one of these big three firms in Bellevue who has this massive staff and all of these tools and gave this client this 80-page comprehensive plan. And it was all fluff for nothing. He wasn't doing squat for this client. So it was just a bunch of risk tolerance questionnaires. And any planner, bringing it back to it before we go to the commercial break, any financial planner that is planning purely on risk tolerances, which are completely subjective garbage, by the way, they are not planners whatsoever. So we're going to take a quick commercial break. Don't go anywhere. Stick around, and we're going to come back, and I'm going to keep educating you on the big no-nos. Don't go anywhere. Stick around.
Are you ready to transform the way you approach sales? This episode is sponsored by the second book in the Capitalize series, Capitalize Your Sales, the all-in-one sales framework that saves you from ever struggling again and teaches you how to sell with sincerity, which dives deep into the art and science of driving sustainable growth. Packed with strategies that go beyond surface-level techniques, this book will help you understand what it takes to truly connect with clients, build long-term relationships, and close deals. Whether you're looking to fine-tune your sales craft or break through to the next level, Capitalize Your Sales offers a roadmap to success designed for today's fast-paced business world. Head on over to your favorite bookstore, order today, and start capitalizing your sales immediately. And now, back to the episode.
Welcome back from the commercial break. We're going to get into number 4 of the what not to do's when selecting a financial advisor, which is number 4. Don't forget to ask about credentials. So in life, plenty of advice may come cheaply. Not when it comes to financial advice. So financial advice can have life-altering consequences, and as such, you could consider asking your potential future advisor about their tests passed, their licenses awarded, and credentials earned. Here's my take. I agree. However, you want to put it into context a little bit. So if you're talking with a kid in his or her 20s that have just graduated and they're working toward their CFP, the intent is clearly there, but they just haven't had enough time to go and pass the exams. And also, they're not cheap. When you go and buy your study, you buy your study material, you get your preliminary requisites done before you go and sit for the Certified Financial Planning Board. Like, I think for me, I paid, it's been a little while, but all in $7,000 for prep and study and all that fun stuff. So again, not cheap, especially when you're just coming out of school and you may be living paycheck to paycheck. And a lot of these groups won't go and pay for these things. You're going to have to do it on your own. And I also want to be really clear for those of you that are listening in, that are in your 20s, that maybe are pursuing this industry, which I think is awesome. I have a soft spot for you because I was there at one point. And on the flip side of all this, if you're talking to someone and assuming you're interviewing an advisor and they're in their 40s or 50s and they've just been doing it for a while, and that's the excuse of not getting more credentials, I would find someone else, because the whole idea of financial advising and financial advisors, I've spoken about this a ton in the past, it's a dying breed. It's a dying career. Certified financial planners are going to be the only option, because financial advising, it'll be extinct from either Google or ChatGPT or whatever AI wants to take that over. So again, if you're talking with someone that doesn't have their credentials, put it into context. But if you're talking to someone older that just, they're not doing it because they're older, find someone else. The fifth not to do: don't misunderstand advisor fees. The F word. Fees matter. High fees may cut into potential returns and affect your overall nest egg. But the ways fees are levied may vary. Some advisors are fee only, charging a flat fee regardless of usage. Others may take a percentage of all the assets under management. Some may earn commissions directly from mutual funds or other financial products, which could present a potential conflict of interest. Here it is. Here's my take. I 100% agree on the not misunderstanding fees. You want to know what you're paying for, okay? The whole idea, and I said this before we went into the commercial break, the whole idea of commissions being the only way someone has a conflict of interest is garbage. It is first-class bullcrap. Also, check this out. Sometimes it's more appropriate charging a commission versus a fee for something that is just going to sit there with zero liquidity. And I could use an example right off the top. So we've worked with alternative investments in the past, whether it's real estate, like a limited partnership, or private equity. It doesn't really matter. There are some alternatives where it actually makes more sense to charge a commission only. In some cases, that may be the only way we're able to charge is a commission for that specific strategy. So let's just role play here. So let's say you have $100,000, you buy an alternative investment for a commission, and that commission up front is $5,000. So, or 5%. So $5,000 off of $100,000. So you got $95,000 in the dirt, but then you're not charged anything for the rest of that investment's existence. So let's also say that that $100,000, it grows. And even though, again, 5% upfront, in 10 years, it doubled and it grew to $200,000. Well, again, you haven't paid anything for that investment since that initial 5% upfront. Well, on the flip side, let's say that you're a fee-only fiduciary advisor, and because commissions are bad, you have to charge a reoccurring fee for that, because if not, you're the devil. And so it's 1% every year that you hold that investment, because we're doing it in the name of fiduciary duties. Well, as time grows, so that's 1% for the 100,000 in year one. Let's say it's 1.1. So $1,100 in year two. Let's say it's $1,400 in year three. Let's say it's $1,500 year four. Again, it's just sitting there. It's just sitting there. Like the planner, other than continuous due diligence, there's really no activity that needs to be done for that. So in 10 years, you've paid this fee-only fiduciary advisor upwards of, I don't know, $10,000 to $15,000, depending on the growth and all that. Well, why is that in the best interest? You should have probably charged the commission up front for $5,000 and called it good. But according to the fiduciary standard, that is considered inappropriate. Like, give me a break. So the misunderstanding fee side of things, again, I agree, but just because someone is fee only, that does not mean that they're the second coming of Christ. Commissions are not bad. Recurring fees are not bad. And it's up to the planner to explain to you the pros and cons of each. And when you walk away, you should not have a question as to why certain things are charged certain ways, period. And last but certainly not least, number 6, don't hire an advisor that hasn't been vetted. Chances are there are several financial advisors in your town. However, it may seem daunting to choose one. And here's my take. That is 100% agree from the Cap and Capitalize, and it is clear cut. So with that brings us to the conclusion of today's episode on what not to do when selecting a financial advisor. I hope this is valuable for you when you're interviewing for that next financial advisor or planner, if you choose to do so. As always, I'm your host, Chris Ray Paniotu, certified financial planning professional, the Cap and Capitalize. And until next time, keep capitalizing. Take care. As always, thank you for joining me today. If you have questions about today's episode or any personal finance questions, please reach out to me at Cap and Capitalize on Instagram, Chris@capitalizeyourfinances.com, or via our website, capitalizepodcast.com. If you want more Capitalize Your Finances content, head on over to capitalizepodcast.com and check out our blog, free resources, book, and online course. As always, I'm your host, Chris Ray Paniotu, certified financial planning professional, the Cap and Capitalize. And until next time, keep capitalizing.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice, and its accuracy cannot be guaranteed. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, yes, whichever is longer. Stock investing includes risks including fluctuating prices and loss of principal. Bonds are subject to market and interest rate risk if sold prior to maturity. Bond values will decline as interest rates rise. Bonds are subject to availability, change in price, call features, and credit risk. Before investing, carefully consider a mutual fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Alternative investments may not be suitable for all investors and should be considered as an investment for the risk capital portion of the investor's portfolio. The strategies employed in the management of alternative investments may accelerate the velocity of potential losses. Christopher Paniotu is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. Capitalize Your Finances LLC is a separate entity from LPL Financial. Capitalize Your Finances is not registered as a broker-dealer or investment advisor. CRPS conferred by College for Financial Planning. Any other individual or company mentioned in this podcast are not affiliated with Capitalize Your Finances or LPL Financial.